Hi, I am Basavaraj Sonagati from basuniways.com. Many of us blindly invest in aggressive hybrid funds thinking that as there is certain debt component, they are less risky to typical 100% equity funds. And second important aspect is as they have to minimally maintain 65% in equity, they qualify for the equity mutual fund taxation. So by default, the remaining 35% of the debt portfolio will also come under the equity taxation. So for that reason, certain people will choose the aggressive hybrid funds. And there are other categories of investors where they think that if we hold separately equity and debt portfolio, and whenever we churn the portfolio to maintain the same asset allocation, then we end up in paying the tax or else exit road. So to avoid all these confusions, is it not wise to hold the simple aggressive hybrid funds? Fine, in a broader sense, this looks very fantastic. However, if you go deeper and try to understand their portfolio, you find so many surprises. I know many people will not go that much deeper. They just look for the returns and they believe that debt means to a certain extent safe. Today morning, when randomly I was checking the portfolio of all these aggressive hybrid funds, I found one important aspect and I thought to share with you all. This is with respect to the debt portfolio of all these aggressive hybrid funds. See, if you look at the yield to maturity of all these aggressive hybrid funds, you notice that their average maturity is ranging from 0 to almost around 28 to 30 years. Take for example, Access aggressive hybrid funds, average maturity of their debt portfolio is 0.4 years. I mean, the fund is holding less than 1 year maturing bonds. However, in case of a grow aggressive hybrid funds, the average maturity of the bonds for this particular fund is almost around 28 years. This I am talking about the average. When I say average, certain bonds may be of less than 28 years and certain bonds may be of more than 28 years maturing bonds. In such a situation, if your aggressive hybrid fund is holding the long-term bonds, then obviously they will pose huge risk to interest rate volatility. Let us assume that they are investing in central government or state government or else top rated, AAA rated bonds. Even in such a situation also, if your fund is unluckily holding the long-term bonds and you are not accustomed to the volatility of such a interest rate volatility, then such a aggressive hybrid funds may pose huge risk for your portfolio. Assume that your requirement is less than 10 years and if your aggressive hybrid fund bond portfolio is maturing 15, 20 years or 28 years, then obviously just assume the volatility it can create to your overall portfolio. So for that reason, what I am trying to highlight with this video is that don't invest blindly in aggressive hybrid funds just because they qualify for the equity taxation, just because by default the asset allocation is maintained, and to avoid the expenses of taxation. You have to go deeper, try to understand where these aggressive hybrid funds are investing. If they are suitable for your risk appetite and your requirement, then only go ahead. Otherwise, simply avoid such aggressive hybrid funds or else simply avoid the blind investing in any mutual funds. Thank you for watching this video.